Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options.
Some of the assumptions for FX options models for FX options pricing. Remember we talked about the distribution, that curve? Well, one is that the exchange rates are efficient, means that essentially you can't predict the future. And a lot of us think we can. And, I think that markets are pretty good at pricing, but not perfect. So I'm not necessarily sure if the markets are actually completely efficient. Number two, interest rates are constant for the two currencies. Of course, that's not true. In fact, these are what I call almost myths, because we don't have fully efficient markets. We know interest rates are changing. Number three, volatility stays the same all throughout the life of the option. Not true. Number four, currencies can be borrowed to facilitate hedging. Well, we can do that normally, so this is not a problem. And markets do not gap. Markets do gap. Now, they might not gap to the same degree that equity options do, but markets do gap. So theory and pricing. In reality, options rarely ever trade at one universal rate or one universal volatility. The difference in volatility is called option skew. And please continue to come to classes. I'm going to be talking more about option skew, as Live Vol has some tremendous graphic material. I'm going to show you a little bit today about how they graph this skew. It's really neat. Traders might want to study the volatility skew structure. So here it is, and they offer this. So if you're a subscriber of theirs, you can go to Live Vol. I think it's really neat. If you're trading the currency markets, you're probably going to want to have this stuff. And you can go there. Their pricing is, I think it's either $100 a month or $250, depending on who you are and the package that you select. But if you look at this, what this is saying, this is what's called a volatility curve. So you have the red, yellow, green, whatever, light blue, dark blue, and purple. What this is saying is that there's an upward slope, and this is the U.S. against the Canadian. So the currency market is saying that more than likely the currency pair value, U.S. dollar Canadian, will get more volatile if the dollar moves up. So this is helpful to understand if you're trading currencies, spot currencies, if you will. Obviously, if you're trading options, you need to know that there is a bit of a different view if the U.S. dollar Canadian moves up, that the market will probably get more volatile. Remember what happened in 2008 when the dollar was significantly higher? We saw more volatility. So that's what this option chart, you can get this at Live Vol, that's what it's saying. And you also get the implied volatility today. It was 11% for the short-dated option, 12% for the second month. They have some neat stuff here. It's very, very cool. Looking at the euro against the dollar, it's the reverse. So what this chart is saying is, well, not necessarily the reverse. It looks the reverse, but as the euro drops, and that's what's been happening over the last 2-3 months, the markets are now, the markets should get more volatile. You see that by the left side of that curve. So in both of the cases, of course, one was the base currency, one was the core currency. If the dollar strengthens, the markets are going to get more volatile. How can you use this, whether you're trading currency options or you're trading equity options, ETF options? You should watch the dollar. What the options market is saying is the dollar strengthens, the market might get more volatile. At least those are the first two. Let's look at the British pound and the U.S. dollar. So what is this saying? Well, as the British pound, if the British pound weakens, which means the U.S. dollar strengthens, we're going to see high volatility. So 3 for 3 in these charts, essentially saying that if the dollar strengthens, we're going to see more volatility. This is helpful for your trading, I would think. Australian dollar against the U.S. dollar. So what does it say? If the Aussie dollar weakens, you're going to see more volatility. Today, we saw the Aussie strengthen option premiums came down, but believe it or not, we saw a big move. Australian dollar moved 1.8%, which is a huge move. That is huge, much greater than the option market was predicting. Another one of my favorites is the U.S. dollar against the Japanese yen. And this, of course, is saying that the dollar-yen, it moves a lot like, and this is actually look much different than all the other slides, because what this is saying is that the dollar weakens, we're going to see more volatility. So dollar-yen moves a lot like the U.S. equity markets. So very, very interesting. The dollar seems to be have sort of that reverse, so the inverse correlation to the equity markets, except with the yen, it sort of should move, or at least it's expected to move the same. Dollar against the peso. So if the dollar strengthens, again, we're going to see more volatility, and that's what we saw in everyone except the yen. So the changing parameters, I hope that was very, very helpful. I found that to be very, very, very powerful stuff. Helps me understand what's going on in the currency markets, and that hopefully can help you in not only the currency markets, but in the ETF markets, in the equity markets. And again, trading currencies, no matter what you're doing, when you're buying an asset, you're going to use a currency. So the currencies, to me, are the first thing that you should look at. After that, how you use them is up to you. Changing parameters that go into an option pricing model, we might say if the strike price was reduced, if we increase the input, if I increase the strike price, the call will be reduced, the put would move up. If the stock or the exchange rate goes up, well, we know what should happen. Calls should go up, puts should go down. Time left until expiration. If we added time, both calls and puts would be worth more. In fact, has the same effect as something else. Raising vol. So those are the same. And the other things are the interest rates. If I was to increase the rates of the base currency, so in the case of the AUM, the puts are going to move up in value, the base currency. Calls move down. If it's the quote currency in AUX, then the call's going to move up and the puts are going to go down. You might see different prices. So what does that mean? Market professionals use different models. Hopefully, I know I only spent an hour with you guys, and of course I'm going to answer a couple questions, but it's most important to understand this stuff, and then when you get your view of the world versus what the market's expecting, you might have a trading opportunity. That's what I'm trying to say here, is that prices are too high relative to what you think. Well, that just means there are more buyers relative to sellers. It might be an opportunity for you. Prices are too low. Well, maybe you want to be a buyer, or maybe you just want to figure out why everybody else is trying to sell. Again, you want to think about all this. Pricing differences are based on the aggregation of all the market participants, future expectations for volatility. Why would you care about all this? Without variances in interest rates and volatility, options would have no value. If you gain a better understanding of options pricing, it allows you, as an investor, to understand the risk-reward trade-offs. Options pricing is based on the theory that exchange markets are random and efficient. The Black-Scholes model, Garmin-Colhagen, or whatever other model, gives you guidance on an options price. It does not guarantee a certain price. So to summarize, the models will calculate theoretical prices based on a currency pair, strike price, time left until expiration, interest rate differential between the two currencies, and volatility. Volatility and the interest rate differentials between the currency pairs are the most important option pricing parameters for investors to consider when you're trading the ISE-FX options. If you have a better understanding of the model, well, then you'll be able to select the option strategies to make most sense for you based on your own goals and your own risk tolerances.
Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE-FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.